Hello everybody, this is Daniel Zabala, and in this video we're going to be taking a look at ETFs investing and what that looks like, how to build a portfolio with ETFs investing for the long term. This is level 3 in the 10 level financial education course module that I'm creating for here on YouTube. Levels 1 and 2 were much more basic, kind of an introduction to personal finances and money management and some overall concepts around that. I'm really excited about this level 3 and going forward. The first two levels were a lot of information, a little bit more dry, and a little bit just a lot of information to pack into one presentation, or well, two different presentations. Each of them were about an hour long. This one, I don't know how long it's going to be. It's 35 slides, but the slides are simple, and I try and go at a good pace, not too fast, not too slow. And so I will attach the presentation in the description below. And so feel free to just look at the slides on your own or follow along. And here we go. So first off, a disclaimer. With investing or any trading activities, past performance is not an indicator of future performance. Investing in all trading activities in the financial markets are inherently risky endeavors. I personally do not make investment recommendations or suggestions. My videos are purely for entertainment and educational purposes only. So let's dive into what is an ETF versus a mutual fund. So if you have a 401k through your employer, more than likely you're investing in what are called mutual funds or maybe index funds through that 401k, and more than likely also your employer outsources that 401k through a company like Fidelity, or there's a ton of them out there. So that's just an example that I know is pretty common around here in this area where I live. So a mutual fund is think of it like a bowl of fruit, okay? A fruit bowl, I should say, actually. The chef or the fund manager of that mutual fund chooses the ingredients, aka, yeah, the stocks or whatever goes into that mutual fund or the fruit bowl, and adds to and takes away as he or she sees fit. And maybe a few shares of Apple here, a few shares of Boeing there, or even partial shares, and just it's a mix and a blend, and it's put together by a fund manager. And most mutual funds are going to be actively managed, so they have much higher fees. Index funds can have slightly lower fees, but mutual funds have higher fees. And just keep in mind, if you really want to know what all the fees are for your mutual funds, you need to read your prospectus, because whatever they quote you as the management fee, it's always going to be more, because there's also, well, usually it's more. There are other fees that are tacked on that are associated with that mutual fund, but you really won't know about them unless you really take a really good look at your prospectus and to see what those are. So it's very common. The fees range from as low as around 0.75% for index funds, but more actively managed mutual funds, probably like 2 to really upwards of 4%, maybe even more, but very common 3 to 4% on fees alone for mutual funds. A lot of people don't realize that, know that, and that's really important to understand and know, because that really cuts into your profits and earnings. So realistically, with mutual funds, you can expect on a well-diversified, good quality mutual fund, being really realistic after your fees and everything, on average, annually, we'll say you could expect to make 7, 8, maybe at most 9%. I mean, at 9%, that would be assuming that you're getting 12% return with 3% fees. So just keep that in mind. That those fees are really, really eat away at your profits. So realistically, you're looking about give or take 8% at most on mutual funds. But ETFs are very similar. ETFs are like a fruit basket, okay, a basket of fruit. Once they arrange, they're left alone. There's no fund manager, there's no one actively managing it. Because of that, the fees are significantly less. 0.5% or less is very, very common. A lot of the most liquid or the most actively traded or invested in ETFs have fees that are under 0.25%. So that's really great to know. It's statistically, the returns are about the same. If anything, ETFs might do slightly better, simply because they don't have those fees by not being actively managed. So you get the diversification of having a lot of different investments in one thing, an individual ETF without the high fees and costs associated with having a fund manager manage it for you. All right, moving on. So brokerage accounts. Similarly, you can think about your brokerage accounts kind of like this. This is an analogy, okay? So your regular and investment and trading account, we like your refrigerator. It's simply a place to hold stuff, right? The refrigerator holds food. Your regular self-managed brokerage account would hold your stocks, your bonds, whatever you invest in, right? And then your 401k is like your freezer, okay? Your 401k is your retirement account through your employer for the long term. You put stuff in your freezer, aka stock, for the long term that you plan on using way down the line. And likewise, your Roth IRA is like a deep freezer. It's also for long term. It's a retirement account, but you would set this up on your own. And you can not only invest in mutual funds or ETFs, you can invest in stocks. On these two, you can invest in stocks, bonds, ETFs, mutual funds, futures contracts, use options, all kinds of stuff. 401k, you're limited to what your employer's 401k plan offers. Most of the time, mutual funds, sometimes ETFs. So just keep that in mind. So this is simply a place to hold your stocks, your investments, okay? Your Roth IRA, 401k, your regular self-managed brokerage accounts that you might open. So again, you have the fruit bowl, like your mutual funds go in the freezer, or if you have ETFs, they can go in there too, or your refrigerator as well. This is a refrigerator, not a freezer. So just a good little analogy. Again, this is your account that holds the investment. This would be a mutual fund. This might be an individual company stock. Okay? Stock is ownership in a company. Moving right along, interest rates of return. So this is we're going to take a quick look at this. If you watch the first two videos, you've seen this chart twice already. But this shows I'm not going to go spend a lot of time on this slide, but this shows the power of compound interest. Okay, what compound interest does, it shows us how long it takes that money to grow on top of itself. And with the rule of 72, it tells us how long it takes the money to double. So at 3%, your money doubles every 24 years. Invest $5,000 one time, and by retirement, you have $20,000. Likewise, if you invest at 6%, it doubles every 12 years. 5% $5,000 invested one time will double, and double again, 80,000 at retirement age. If you can get 12%, mind you, so for example, those mutual funds, you get 12%, but you minus your 3 or 4% fees, you're in between here. But if you use ETFs and you can get 12%, well, now you don't have to worry about those fees. 12% is actually attainable and realistic. So let's say invest in ETFs, for example. One-time investment of $5,000 at 12%, it doubles every 6 years. Okay, so that money will double, and it grows to over 1.2 million at retirement age. Okay, at 12% compound on top of itself. Now, keep in mind, if you are under the age of, I think it's 40 or 50. I can't remember off the top of my head actually. I think it might be in a future slide. The maximum you can put into your Roth IRA per year, as an example, is $6,000. After a certain age, you can put an additional $1,000, so $7,000 a year for catch-up to make up for lost time, which is helpful, but it is. Anyways, moving on. And so imagine if you put $5,000 or $6,000 every single year into your retirement account, especially your Roth IRA. Your 401k, this is tax-free, or I'm sorry, not tax-free. This is tax deductible on your annual taxes due, and this would be taxable at retirement, 401k. But a Roth IRA, this number would be tax-free to withdraw at retirement. So Roth IRA is definitely one that would max out what you want to max out as soon as possible, as much as you can, every single year. So this is a one-time investment. Imagine if you invested every single year $5,000 until you retired. This would be significantly much larger. And lastly, real quick look is if you could get 24%, your money would double every 3 years, and it would grow to over $320 million by retirement age. A lot of people have no idea that you can get 24%. You very much so can. It is attainable, but most people have no idea how to attain that, and very few people know how to, let alone teach it. And I'm going to show you a theoretical example of how to attain 24% interest. But this really requires you. There's no way you're nearly impossible, not impossible, but very unlikely, I should say, that you're going to get this kind of return in using someone else to invest. Sure, if you invested in a great company, like for example Berkshire Hathaway, I'm not recommending this, but like Warren Buffett is phenomenal. He's over the years they've been able to return over 20, an average of 20 to 24, 25% each year. It's like he actively manages their investments. But of course, there's fees. There's always risk, right? The best thing is to educate yourself and invest on your own. So if you invest in ETFs, learn how to pick individual stocks using fundamental analysis, using option strategies as forms of hedging your risk to the downside. If you don't know what that means, watch future videos that I make, and you can learn what that means. Using options, using investing in stocks, ETFs, a diversified portfolio not only of different types of investments, but also different methodologies. Okay, different products, different strategies, different methodologies. That's how you can attain this 24%, right? But even in this slideshow, or this presentation, I'm going to show you an example of a theoretical portfolio 15 years ago that would have produced an average return of 59%, which is crazy. Liquid ETFs. When you invest in ETFs specifically, or stock for that matter, you want to make sure that they're liquid. What that means is that they are active. There's a lot of shares being traded in the financial markets every single day. Okay, so if there's more than 500,000 shares traded each day on average, it is said to have healthy liquidity. Liquidity, think of it like water. It's fluid. It's liquid. It goes easily and smoothly in and out of the markets. Okay, that's what that means, and that's really important when investing, and especially if you get into trading, any form of trading activity for short-term capital gains profits. But ideally, 1,000,000 shares or more per day is even better, especially again if you're trading. So investing, you can go a little bit low, you can go lower liquidity, but it's important that you have healthy liquidity in whatever you're investing or trading in. So these are some of the most liquid, okay, highly liquid. They're AKA highly traded, commonly used, most popular ETFs that are out there in the market. Okay, so SPY is one of the most common ETF, and it invests in the S&P 500, which are 500 of the strongest or largest companies in the U.S. Okay, QQQ is the NASDAQ 100, a lot more tech companies, 100 companies there. The Dow Jones Industrial Average, the Russell 2000, these are small, maybe small or mid-cap stocks. IWM, so these are 4 ETFs that follow stock indexes, as they're called. So S&P 500, NASDAQ, Dow Jones, Russell 2000, right? And then if you want to invest in an ETF that follows the price of gold or silver, emerging markets, global markets, China, Mexico, these are country specific. The euro dollar, which is a type of, it's like a form of currency. It's not the euro, it's the euro dollar. It's slightly different. You can look more into that on your own if you're interested. And then these are by sector, or more specific. So within SPY, you have different sectors. You have financials, energy, materials, utilities, industrials, and so forth. And then you have real estate, if you want to follow the price of oil or the 20-year bond. These are examples of some of the most highly liquid ETFs that are out there. So these are a great place to start when looking at what you might want to use if you're going to invest in ETFs. Again, I'm not making recommendations or specific suggestions. These are just examples. Okay. So let's see. Volatility. So volatility are swings in the portfolio or in an individual stock. Okay. How much does the price move up and down over a period of time, like a roller coaster? Okay. So for example, SPY, right? S&P 500 against BIV, which is an intermediate term bond fund ETF, okay? So basically short-term bonds compared to the S&P 500 stocks, okay? So the red line is much more smooth and it doesn't increase in value a whole lot. And then the blue line, increases a lot, but it's also kind of all over the place along the way. So SPY, or stocks in this case, are much more volatile than your intermediate term bonds, right? It just simply has to do with the swings. In the financial world, when you hear about risk, okay, when people talk about risk, a lot of times what they're referring to is volatility. If you're investing, you want to try to maximize, your profits as much as possible, while also simultaneously minimizing as much volatility in your portfolio as possible. That's the goal, is maximizing profits, minimizing volatility, right? Because look here, if you invested in SPY here, in the short term, you would have lost a lot of that value. In the long term, it went up. Okay, whereas the bonds were much more smooth, but you had barely any return. So volatility is the swings in the individual stock or underlying, or in the overall portfolio. So volatility traders, like day traders, swing traders, short-term traders, they love volatility and seek that out. Volatility for day and swing trader means opportunity. Investors do not like volatility. They seek to minimize, reduce, and even eliminate it if possible, while simultaneously obtaining as high a return as possible. And the reality is you can't minimize volatility. There's always volatility, but you want to do your best to reduce it as much as possible. Portfolio diversification. You've probably heard that you never want to don't have all your eggs in one basket. That's what diversification is. Having different types of investments, but they're actually more than just that. What is the purpose of diversification? It's to make the most, this is worded funny, I'm sorry. It's to smooth out volatility, aka risk and return. So it's to reduce those swings in your portfolio as much as possible to smooth out the returns to the upside, right? And there are multiple ways you can diversify. You can diversify by product or asset class, meaning investing in multiple different stocks and ETFs, as well as real estate, as well as commodities like oil and gold and silver and natural gas, as well as corn and different product types, right? Or cryptocurrency. Those are different product types or asset classes. You can also diversify, add layers of diversity to your portfolio by investing in different market cap. Okay, market capitalization is the size of those stocks, those companies, small cap, mid cap, large cap, mega cap. By investing in different sizes of companies, that also adds layers of diversification, as well as duration and timeline. So, for example, investing for the long term versus short-term trading strategies, like especially when you utilize stock options to hedge your portfolio or hedge positions, or or even placing an outright swing trade because you see an opportunity. Something's moving a lot, and it's speculative. You think it's going to keep moving in the short term, so you might buy it if it's to the long side or to the upside, and sell it once it reaches a certain profit target for a profit, right? And strategy, different strategies is adding layers of diversification to your portfolio and your investments. Day trading, swing trading, using options, aka the wheel, which we'll talk about, I think, in level 4. I go into talking about the wheel strategy using options. But in this particular video, we're focused on the simplest way, which is dollar cost averaging when investing. That's where you invest in your investments, whatever you're investing in, a fixed amount every single month, no matter what the market's doing, up, down, everywhere in between, right? So that's dollar cost averaging. When you invest in 401k, that's what you're focusing on doing. And when you're a beginner, you're dollar cost averaging in your Roth IRA as well, most likely. And if you want to move a step further, you learn about the wheel. But again, that's level 4. So here's an example, okay, of of a simple portfolio having, again, this is just an example to show diversification in the volatility, right? So IWM is the Russell 2000, small cap company stocks mostly. TLT is a 20-year US government bond. GLD is gold, and SLV is silver. So you notice the return, so a starting value of approximately around here over the course of several years, it would increase to roughly around here somewhere. And then the volatility of this portfolio is represented by this black line. By having multiple different, it's called uncorrelated assets in your investment account, when one's down, another one's up. When one's up, another one's down. And they smooth each other out over the long term. This is the purpose of diversification, right? An increase in value with a smoothing of that volatility in the portfolio. So this is a slide to pull off the internet. This is an example of Ray Dalio. He's a famous investor as well, like Warren Buffett. Ray Dalio's, quote, all-weather portfolio. It has an average return of roughly, I think, about 10%, give or take, with minimal volatility. So not a fantastic return, but it's decent, right? It's okay. It's a healthy return, thinking retirement, for example, with minimal volatility. So he shows, based on conditions in the market and the economy, kind of examples of what you can focus your investing in, right? 25% allocation to this quadrant, and likewise 25, 25, 25. If you see decreasing growth in the economy, like we're in right now, with increasing inflation or decreasing inflation, you might focus on these two sides, one of these two. Whereas if the economy is growing and you have decreasing inflation, you'd focus here. Or if the economy is growing and you have increasing inflation, you'd focus on these: cash, emerging bond spreads, commodities like oil, natural gas, gold, emerging market equities. Equities is stocks, okay? We can use ETFs to do this too. Long duration treasuries, those are bonds, right? Inflation protected bonds, like I think they're called TIPS, would be an inflation protected bond. So this is an example of one method that Ray Dalio teaches, that you can diversify your portfolio to minimize volatility if you have that target of roughly 10%. And again, there's never a guarantee, but this is simply one method that ideally, hopefully, would return with minimal volatility. And Warren Buffett, the most famous investor of our time, says, diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. So to keep in mind, for the average person doesn't know what they're doing. So diversification is a great thing. Warren Buffett is a professional who's been doing this for most of his life and has a very successful track record. And so he believes in, if you really know what you're doing, you would have a much smaller basket of diversified investments, and you really focus those efforts where it's most profitable. But if you're managing literally billions and billions of dollars like he does, or even, billions and billions, then you want to, his company does have a lot of diversification. However, if you notice, their top companies in Berkshire Hathaway make up the majority of the allocation in their investments, because he firmly believes in what he invests in, because he does the research, he knows what he's doing. But there's always risk, right? So for you and I, we need to diversify in a healthy way. Asset correlation. So correlation is how similarly do two different underlyings move in relation to each other. So in this example, SPY is the S&P 500, DIA is the ETF for the Dow Jones Industrial Average. We see that over time they move in very, very similar fashions, okay? They look almost identical, right? Because they're so highly correlated. So this is high correlation. whereas GLD, representing gold, in relation to the Dow Jones Industrial Average, are highly uncorrelated. They move in a more random fashion. It looks like almost opposite, but it's not quite opposite. They're not related, so they move in different ways. Unlike these two that move very, very similar, right? Highly uncorrelated. Optimal portfolios, and again, these are all just examples and for teaching purposes only. So what is your goal if you're investing? Is it preservation of capital to minimize volatility, like in your retirement account? Especially if you're older, this is probably one of your goals. If you're young, is it to maximize growth? Or if you're older, if your goal is to maximize growth, you got to determine what's your goal. Market correlation method, or is your goal to have as much income from your investment account as possible through dividends, high dividend stocks or ETFs? You would have some growth, maybe some moderate growth with some income, or a blend of different goals, right? To learn, to build wealth, retirement, you got to determine what your goals are. And these are just two examples again: Apple versus Kroger, right? Apple went way up, and Kroger's steady to go up. So this again is just an example, and to maximize profit. So this is an example of, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 different investments, 12 different asset classes as well. So we have energy, financials, silver, gold, utilities, bonds, as well as the other major sectors as well. By diversifying properly, you minimize volatility, aka P&L swings, profit and loss swings in your overall portfolio. This graph represents one share of each of these, okay? And the reason I blocked these out is because these gray boxes are covering individual stocks for this theoretical portfolio, okay? Because I'm not making recommendations, as well as I've studied finance and stock market for over, 12 years now, and so all that time and work and energy I put into it, I don't want to give everything away, right? So, nor be liable for someone else making decisions. So, so this is examples from December 1st, 2006 through the end, roughly the end of 2020, right? One share in each of these. Portfolio allocation. Now, had we invested in the same underlyings in a specific portfolio, this would have been what it would have looked like over that 15-year period. Okay. So $10,000 invested one time, okay, in these 12 different ETFs and stocks at these allocations back then, right? Again, this is not a recommendation to invest in any of these, let alone these allocations now going forward, because the past is not an indication of the future performance. This is an example. But had you invested $10,000 one time 15 years ago, 12% in this stock, 2% in energy, 7% in financials, and so forth, we would see a return in the portfolio starting off here. $10,000 grew like this. Okay, it went up in value over time. Way up, right? Way up. These top three especially made huge astronomical gains, and these all made steady and slow gains up. So sector is blocked out. Okay, these gray boxes represent stocks from the following sectors, not in any particular order: industrials, consumer discretionary, healthcare, consumer staples, and real estate. Okay, and this bottom line shows how do you invest in $10,000 one time and never touch it again at these allocations. By December 1st, 2020, those allocations would have changed on their own to these amounts because of how much each individual ETF or stock went up in value or not compared to the others. So in your Roth IRA, for example, If you want to keep things even more steady, then you can implement rebalancing once or twice a year to make sure that your allocation amounts stay roughly consistent. Choosing underlyings. So in that particular example, okay, 12 ETFs and stocks, okay, with those allocations 15 years ago would have produced $10,000, grew to over $78,708. And mind you, this does not even factor in dividends being paid out and reinvested in the account. That is simply from the share price of each of those increasing in value. The total return for 15 years was over 787%, or an average annual return of over 56%. I said earlier in the video, I think I said 59%, simply because I forgot. Over 56%. This was a theoretical long-term investment portfolio using ETFs and stocks in really healthy companies that have been researched. One-time investment of $10,000 grew by over 56%. Now, is everyone going to do this? Absolutely not. But is it possible and attainable? Yes. Warren Buffett actually I'm going too fast. Warren Buffett has said that he believes he could very much make, over 50% per year if he was managing a small sum of money. The thing for him is his company, they're managing billions and billions and billions of dollars. So they have to diversify more, and they're also limited in terms of what they can invest in order to minimize that risk. So that's why their average return of long term is roughly that 20 to 25% range. And you never really see it go higher than that. Because of the way they have to invest, because of the amount of money they're investing. But if you only have maybe $1 million, $10,000, right? $1 million, $10 million, then this becomes very attainable, right? It's actually possible to do. So when I did this analysis and I saw this, I was like, well, shoot, my research pays off. That's really good. I wish I had done that 15 years ago when I was. I would have been like 16, so I couldn't, or something like that. But, it's almost going forward. It's encouraging to know your research. The theoretical projections are very encouraging and good, right? Again, this is just an example. So this data is pulled from every 3 months, and I do have an Excel document that I calculated all this out on. It took me a while. So investing strategies, again, if you're watching this video, you're focusing on dollar cost averaging is the best method to start for beginner investors in your 401k, your Roth IRA, individual brokerage account. Once you want to learn about picking stocks, picking high quality individual companies to invest in for long term, it's important to learn about fundamental analysis. Okay, fundamental analysis. And then a great hybrid method is called the wheel. That's the strategy. It helps you to buy stocks lower and reduce your short-term risk on stocks that you own, or ETFs for that matter, that you own, as well as increase cash flow. Because in these stocks and ETFs, the only cash flow you have if you're dollar cost averaging is dividends and distributions of earnings that the company might or the fund gives out, right? So it's dividends. But if you use the wheel, which is using stock options, in conjunction with your investing activities, you reduce short-term risk and increase cash flow. Okay, so you get dividends and the cash flow from those options that you're selling on against the stock that you own. So dollar cost averaging, fundamental analysis is for picking individual stocks, right? And technical analysis is for short-term trading, whether it's day trading, swing trading, using price, action, and volume, and technical indicators, and things of that nature, right? And statistics or quantitative analysis is used if you're simply selling premium or selling stock options, right? And if you do the wheel, it's a hybrid of all three, of investing, trading using technical analysis, and selling premium using statistics or quantitative analysis. Seems like a lot to learn, but anybody can do it. It's just a matter of putting in the time and the effort. And you can learn how to use these different methodologies for making your funds, your money grow over time. Wrong way. Okay. Portfolio maintenance, last little bit. I think we're getting near the end of this slideshow. In your Roth IRA, for example, it might be a wise decision to rebalance your portfolio once or twice a year to maintain those equal allocation amounts that you set from the get-go. Because, for example, like right now, stocks have been ripping up and bonds have been tanking down. So like right now, if you had that one-time investment, $10,000, say 6 months ago, now your stocks are way up and your bond allocation's way down. You might be like, okay, I'm going to rebalance by selling a little bit of the stocks and put in that cash and buy some more ETFs and bonds, right? To kind of rebalance those allocations. You can also do one-time catch-up additions to help rebalance a bit. For example, if you do your taxes and get a tax return, you might invest that into your regular brokerage account, and instead of rebalancing by selling something and investing it elsewhere, you might simply just add cash to a specific investment. Or in your retirement account through work, you might just go in and change the allocations amount for future contributions a little bit. And adding and changing the underlyings being contributed to. So in your 401k through work, for example, maybe you have 5 or 6 different ETFs or mutual funds you're investing in. Maybe you look at them and say, okay, this one's not doing that well, but I'm not going to just get out of it. I'll stop investing in said mutual fund or ETF, and instead I'm going to invest in something new, something different through that. So that's another way to do maintenance in your portfolio. And mistakes to avoid when investing. Putting too much money into one single ETF or stock. If you really, really know what you're doing, 30% is one maximum, but a safer allocation, in my opinion, a wiser, is you never want to put more than 15% of your cash or your capital, of your assets into one single stock or ETF investment, okay? You never want to put too much weight in any one quote-unquote basket, right, if you will. It's just not wise, right? Mistakes to avoid: speculating and gambling via the stock market using penny stocks. I'm not saying that day trading or swing trading penny stocks is always gambling. If you have taught yourself, learned how to be a professional trader, that's a very viable business endeavor. But for the average person, simply saying, "Oh man, this penny stocks just soared up 1,000%. I'm going to get in." That's a gamble, and most likely you will lose. That is reality. Especially when you're first learning about stocks and investments and stuff, it's exciting, and everybody thinks that they're different, they're special. Like, oh, I see this opportunity, I'm going to make a ton of money. Well, it's a lot harder than you think. So, learning is the wise thing to do. Is put in the time to teach yourself, and speculating is fine, but keep it really small. But if you're going to gamble, go to the casino. Don't gamble via the stock market. It's just not wise. Taking money in and out constantly. If you're investing, remember, we're investing right now. We're not focused on trading. So you want to invest something and leave it alone. Be patient. Don't be impatient. You also don't want to use debt to invest in stocks. Don't go take out loans to invest in stocks. That's just risky. It's not like buying a piece of rental real estate. Keep that in mind. Only invest in your. This is mistakes to avoid. So don't just only invest in your 401k. Don't only invest in mutual funds. Make sure to continue learning. Don't make the mistake of not continuing to learn. And when you see, if you're picking individual stocks, make sure be cautious and aware and wary of mergers and acquisitions, as that can affect a lot with the stock price. Avoid low liquidity underlyings, and try to avoid buying at all-time highs if you're investing, right? This is not trading. You're not trying to buy high and sell higher. You're trying to invest ideally low and it go up in value over time, and either never sell or sell slowly over time and when you're old, right? Or pass it on to your loved ones. And also waiting to start. Don't make the mistake of waiting to start. Going back to simply quick rule example is the rule of 72. There we go. Right, simply by waiting, you lose, right? So here, age 25 to 31, if you wait 6 years to invest that one-time $5,000 investment, well, knock off the bottom number. At retirement, at age 73, you'd have only this amount and not this amount, simply because you waited to start investing for long term. So that's a big mistake to wait. Is time is your biggest asset when investing for long term. Well, here we go. Next slide. That was the point I was going to make, was don't make the mistake of waiting, because that significantly impacts your returns in the long term. And here's some helpful resources: Investopedia.com, Morningstar.com, Value Line, and Yahoo Finance are all great resources to learn about or have tools for investing specifically. If you want to open up a free account through M1 Finance, that is a brokerage account that is very user-friendly, that you can set automatic investments in and rebalance automatically if you want to. Well, not automatically, but it makes it very easy to rebalance the portfolio. It's a really user-friendly, great place to start dollar cost averaging investing on your own. And TD Ameritrade is a great platform if you want something much more in depth that allows you to not only invest but also utilize stock options, maybe even day trade or swing trade, or do pretty much anything you'd want, or use futures contracts or anything. Pretty much anything you want to do, TD Ameritrade is a great platform that will allow you to do that, as well as they have a really phenomenal free software that you can use called Thinkorswim. And if you want to just play around with seeing what the correlation between different ETFs are, or assets like stocks, this website is a great tool as well to just give you an idea of what the correlation looks like based on past performance of different underlyings. And you want to make sure, and I'm really getting towards the end of this, this last two slides. So with retirement, long term, what is your goal? What's your financial freedom number? And this is just an example of something to consider when investing. This is your stock portfolio versus rental real estate, right? So if your goal was $1.5 million for retirement, 1.5 million invested at 8% means you would have roughly 2% of return to live off of. The reason for this is because 4% to account for inflation. That's the value of the dollar going down every year. The government shoots for, well, they've been shooting for just around 2%. Now they're shooting for just over 2%, but reality is over the long term, the average rate is about 4%, right? And another 2% to account for taxes and fees if it's like through your 401k, right? So this is not 8% growth from beginning to this amount. This is once you have 1.5 million, you want to have at least 8% return, so that you have 6% to account for inflation and taxes, and then that gives you 2% to live off of, which would be $45,000 per year. And mind you, $45,000 per year, 30, 40, 50 years from now is going to be worth a lot less than it is today. Okay, and this is ideally, this number is in conjunction with having absolutely no debt, your house is paid off, minimal living expenses, right? So this is a stock portfolio example. Is that your financial freedom number? Is it too high? Well, it's not going to be too high. Is it too low, I should say? Do you need 2.5 million, 3 million? What's the number for you? You have to determine that and start early. And something to also consider is investing in rental properties. A few over the course of your lifetime makes a big difference, right? So in this example, rental real estate, if you only bought 4 properties at an average price of $150,000 each, right, which can be difficult, but there's always opportunities, then the total initial value is $600,000 compared to 1.5 million. And this is a really simplified example, but your gross rent received minus taxes paid per year gives you roughly 12,000. Well, this is your depreciation amount you can take off, right? Well, I'm sorry, no, this is taxes, but there's also depreciation on the income that offsets the income. Anyways, the point is that this net income per year divided by one property, the cost of that property is 8.6% return, right? This is assuming you invested these with cash, right? You did them outright. Okay, you bought these 4 properties with cash. This would be 8.6% return. Okay, this amount, the per property per year times 4 properties, is an estimated gross income of over $50,000. So really, you only need 4 properties paid off if managing them yourself to make the equivalent of the $1.5 million invested 8%, right, to live off of 2%. So this is something to think about, especially long term, is either maybe acquiring a few rental properties at least over the course of your lifetime, or maybe in retirement in order to stay sharp, stay active. Maybe you've saved up a large sum of cash or investments, and you take some of that out and you can buy some rental properties with cash if you want to do that, versus going to debt using a mortgage. You don't want to use, may not want to use leverage. Use mortgage to buy properties when you're older, right? So this will be another way to have that equivalent, and it uses less than half the capital that you require in that stock portfolio. My purpose in showing this is not to say, hey, invest in real estate and not stocks. It's to show, again, it's important to diversify not only what you're investing in, but the methodology as well. So, and with that, I just want to encourage you to continue to learn and grow. I hope you learned a lot from this video. It was a lot, but I hope it was a blessing. So God bless, grace, peace, and until next time.